Hello, everyone, and welcome to another Altos Trading Live Strategy Session with Jeff Tompkins. This is your host, Richard Van Rich, and we are excited to have you guys with us here this week. Got a lot of information to go over tonight. Really glad you're here. If this is your first time on, you'll notice that your microphones are all muted, and that's so we can all hear Jeff and I talk. But there is a Q&A box. So if you move your cursor a little bit on your mouse, you'll see that the Q&A box and chat box is at the bottom. Feel free to put any questions in there, and we'll get to those throughout the evening and also before we sign off. If you have to hop off for any reason, don't worry. This is recorded and will be available in the members area later tonight and sometime on YouTube tomorrow. And if you're watching us on YouTube for the first time, please like and subscribe our videos so you can get more of them, because we do these every week Tuesday. So hope to see you on the next one. If you have any questions about your access to Zillion, Trade Trend, any questions about any open trade alerts, membership information, anything like that, email support@Altos Trading, and one of our team members will get back to you sometime tomorrow. But before I bring on Jeff, let me just read a disclaimer. Altos Trading LLC and Trade Trend Zillion software is intended to be used as an information service for subscribers, and it includes opinions as to buying, selling, and holding various stocks and other securities. However, publishers of Altos Trading, Trade Trend Zillion softwares are not brokers or investment advisors and do not provide investment advice or recommendations directed to any particular subscriber or in view of the particular circumstances of any particular person. Altos Trading LLC, including its owners, do not accept responsibility for any decisions made by subscribers using the software, and subscribers to the Trade Trend Zillion software or any other person who buys, sell, or hold securities should do so with caution and consult with a broker or an investment advisor before doing so. All right, with that being said, let me bring on the man of the hour, Jeff Tompkins.
Hey guys, I'm here.
Hey.
I'm here. Sorry about last week. Had a little family emergency, but all is well, and I appreciate everyone's who reached out, your concern and all that, but all is good. Just apologize that it was a very last minute thing and couldn't make the session, but for those of you who tried to join last week, again, sorry about that, but hope you're here this week and we'll make it up to you. So we're going to cover some great stuff today, starting with our market overview and mapping out our key levels, of which there are some very significant ones in play this week. So this will be critical for navigating markets this week, particularly. Take a look at the 36-month moving average, since, in fact, our last live session was in November. So we'll recap where we left off as it relates to proximity of the major indices to the 36-month moving average and what that's looking like for December as we approach the end of the year. And tonight we're going to focus for our topic on Heikin Ashi charts. We've had some requests from members and weekly live attendees for this particular topic. And these are kind of a unique style of charting that we'll talk about, basically how the candles are constructed, how to interpret them, and how to use them with the trade trend signals, because they're actually a great combination for identifying trend direction as well as timing the onset of a trend. So we'll make that our topic of focus tonight, and then if time permits, we will open it up to Ticker Roundtable and wrap up with Q&A. And as always, as Richard mentioned, if you guys have questions or comments or anything, you can put those in either the chat or question and answer box during the session. Like this to be, as we discussed previously, as interactive as possible. So if you guys have any questions, don't be shy to interrupt. We're happy to pause and answer those, and we'll do so periodically anyway. So, okay, let's go ahead and get over to our charts and take a look at what's going on in the markets this week. So let me expand this chart of the S&P. Looking at a daily chart, you'll notice we've been in a green divergence cloud now since around mid-October. So we transitioned from bearish to bullish divergence right around the middle of October, which also coincides with our all-time lows for the year, which came in on October 13th. Before we rebound. So good timing there on the divergence cloud shift. And we've had some nice buy signals, just really a couple along the way in this reversal and rotation higher on the S&P. Actually, we got a sell signal yesterday, and it hit the triggered entry price during today's market hours, and so is currently in profitable territory. We'll talk a little bit about this current signal because there's kind of really two potential outcomes here, moving into tomorrow's trading and the rest of the week. And so I'll kind of let you guys know what to look out for there. But it is a counter trend signal, again, because we're still in a green divergence cloud in the context of an uptrend. So it may be short-lived, or we may see, now that we've closed below the 20-period moving average, we could see a continued rotation lower. And I'm going to, as we map our level, show you the level to watch for that. And if it occurs, then we're going to be more likely to rotate lower into the 2 standard deviation move to the downside, which currently resides just a bit above the 3,800 century mark. So for this week, what we really want to keep a close eye on, and really even for tomorrow, is the 3,900 level. So if we look at the lows from today on the S&P, we came down into 3,918, specifically 3,918.39. So just a little more than 18 ticks above this 3,900 level of support that we want to keep a really close eye on tomorrow for tomorrow's trading. And we've talked about this level in previous weeks and how as long as we could stay above it, and when we broke through it back in November, right here, and actually got a trade trend buy signal there, we continued a bit of an upwards to sideways trend with a bit of a retracement back down into that level. So going back into October and earlier November, it was serving as resistance. And you can see we could go further back and find a lot of support and resistance around this level. But it's kind of an inflection point is what I'm looking at it as is for the S&P in terms of differentiating between bullish and bearish sentiment. So we've remained above this level since roughly early first, second week in November, earlier November. And there's some support here around the 3,950 level as well. But now that has transitioned into more resistance because we actually closed just below that 3,941 today. So we're still trending higher, but what happened today is we closed below the mean, the 20-period mean, which is a bit bearish. But as long as we're above 3,900, which again has transitioned from a prior resistance, back here in late October to support, right? So we're now treating this level as support. Now, if we get a close below 3,900, that's the scenario where I mentioned we're likely to see a rotation into lower prices, at least probably into a 2 standard deviation move lower from the average, which would be our lower band here. And currently that's just a little bit above the 3,800 century mark. So that would be a level of support if we in fact break 3,900 on a closing basis. So really, for tomorrow, watch this 3,900 level closely. It's going to give us a good indication of where the rest of the week is likely to end up. If we see either a rejection and rotation higher or a false breakout, so maybe what we could see is another rotation lower in tomorrow's trading, and then a reversal intraday with a close back above 3,900. Either of those scenarios would further strengthen this 3,900 support level and increase the likelihood of a resumption of the uptrend. But if we close below 3,900, that will make that less likely and make the greater likelihood further rotation lower. So that's why this 3,900 level is so key for this week's trading, and probably tomorrow, being that we came down on the lows today so close to that level, we're likely to encounter it again tomorrow. We could get, being that it's such a strong level, and a lot of the consensus among technicians out there is S&P below 3,900 is bearish. Could be an indication that we're gonna see lower prices into the end of the year. Now the other thing that, and so we'll keep this 3,900 on here as support, but the other thing that happened is we have this very significant 4,000 millennial mark level, which we've broken through and then ended up being a false breakout, really. We saw resistance there over the course of a couple of weeks, and then it looked like we were getting a sustained breakout of 4,000. A lot of conviction around that candle from later November, and then all of a sudden we're rotating back down below. So this is this 4,000 level is now resistance, and again support here 3,900, and this is a key zone to monitor through the end of this year, the end of December, and of course the end of 2022 for indication. And of course we'll follow up on this in subsequent weeks, but indication of sentiment going into the new year. So if we can sustain a close above 4,000, our resistance level, by the end of the month and the end of the year, that's going to inject more bullish sentiment into the markets for going into 2023. I think it's unlikely we're going to close in this zone this month. I think we're either going to push above or below. And so if we close below the zone, then we're looking at probably more sustained bearishness into 2023. So that's why I want to emphasize this 3,900 to 4,000 zone, and make sure that we're aware of it. So while we're on the S&P, let's go ahead and take a look at the 36-month moving average. So this is a monthly chart of the S&P 500 index, XPX, and the blue line is our 36-period moving average, which historically indicates when we see mean reversion in bull markets, is often a value zone, as I would call it, for mean reversion, and then transition from a sell-off or a mean reversion into a continuation of an uptrend. And so the bear market this year has, of course, as we hit all-time highs late last year, early this year, we were significantly high off the 36-period mean on the monthly chart. So we had a long way to fall to mean revert, and we've done that. We've mean reverted, and now we're seeing some consolidation around the average, which makes things a bit challenging, especially if you're more of a medium to longer term trader or investor. This consolidation can, a lot of whipsawing going on around this mean. Eventually we'll get a sustained move off of it, but looking back at November, what's significant here, well, even going back further, in October, September, we've got Again, a lot of action around this level on a closing basis. So, we see a September close below with a lot of conviction, almost near the lows, and then a reversal higher in October with a close above, and then a retracement lower in November with a reversal higher. So we've had 2 prior months of strong closes above the 36 month moving average. I'm a bit surprised that we've sold off as much as we have in December. Considering that, it really looked like we were going to continue to push higher. But so far that hasn't happened, although we're only a week into the month. So there's still plenty of time for this to also stage a intra-month reversal to the upside. And there we're actually going to look at another resistance level, which is 4,100. So if you look at the 4,100 level, it's easy to see on the monthly chart how significant that is. We reversed off of it this month. We reversed off of it back in September. You can see that while these were a slight open and closes in previous months above that level, they were close also to the 4,100 century mark. Open that next month, very close. Indecision, I think back in April, May, right around that level. Sell off right into that level, reversal off that level, reversal off that level. So you can see pretty much, except for January, this entire year, we've been seeing a lot of support and resistance right around 4,100. So what does that mean? If we're able to stage an intra-month reversal in December from current levels, rotate higher, and close above 4,100, also, as we looked at on the daily chart, that will align with those, those metrics as well, for injecting a lot of bullish sentiment going into 2023. So we'll continue to follow up on this, obviously, but that's kind of the thinking behind, the S&P and the broader markets as far as sentiment and, really what's going on here. And then, looking at, I've actually got this 3,900 level. It's just slightly below. I believe these are percentage peak to trough sell-offs I was marking, but you can see that this is a bit below 3,900, this red horizontal level, but it also almost coincides with our 36-month moving average, which is just a tad above 3,860. So, and that's why I like to look at these really as more of zones, as versus precise numbers. If you do it that way, it tends to make it a bit easier to analyze and deal with. So we don't want to necessarily use a precise number, but look for this confluence. Like, you'll notice that all of these factors are lining up at around certain price points. That's really what you want to watch for. And then if we do stay like in between, consolidate, then we'll just want to kind of extend this analysis into January. But I think likely we're going to see, because we're at the end of the year, we tend to see, we have the holidays to contend with, and volume tends to thin out around the holidays, particularly around Christmas and the New Year. But we may not see quite the subsiding volume we might see in other years, just because of the significance of the market environment right now. So I would be surprised if we consolidate and we don't either see a strong close above or below the 36 period moving average by the end of the month. But we'll see. So okay, let's run back over to our daily charts on the NASDAQ. And one thing I'll point out too that was a really great clue, and I was bummed we weren't able to hold the session last week, because it was something I was going to point out, although I did point it out the prior week to keep an eye out for it as we were moving down on the VIX, because we'll take a look at the VIX in a second. There was actually a really nice clue from the VIX on this recent rotation lower over the last 4 days or so. But looking at the NASDAQ, so a similar picture. As far as the trade trend algo, it put in a pending sell. If we break down below, let's see the entry. This is on the Qs, the NASDAQ 100 ETF. So the pending entry price to the short side would be 279.69. So just below the low of today's low. So this is still a pending signal, whereas on the S&P we had a triggered sell already. But similar picture as far as what's occurred with the key levels. Really kind of a false breakout, and then rotation lower, and then a close below the 20 period moving average. So what we want to watch for key levels on the Qs tomorrow, 280. And so you'll notice somewhat similar to the 3,900 level on the S&P. This is kind of our key support level, and you'll see we just really came down into that level today. But if you look, back, you see all this support, prior resistance, support, resistance. So this is our key support level for tomorrow. And same analysis is on the S&P. If we close below, I'm looking for a sell-off into the 2 standard deviation move lower, which currently resides around 270. So, we'd be looking at like a 10-point drop on the Qs. If this level holds tomorrow and we rotate higher, then I expect at least a return up into prior resistance, which is kind of right around the 292, 293 level. And then, expect to maybe encounter some resistance there. If we can break through that, then we've got, it's pretty much clear from there. We could have a long way to run to the upside. And then if we have a false break of 280 tomorrow, so we trade lower, maybe, probably in the overnight future session, we could gap down, we could open close to the close of the day, and then with futures flat overnight, and then trade down, and then intraday tomorrow reverse higher. But that's what we're looking for, one of these scenarios, whether it be a false break of 280 and then a close above, or this 280 level holding and just opening above that level tomorrow and then closing bullish. Those are the scenarios that would be a bullish case scenario, and then again a close below more bearish, because then we'd be breaking a key support level. So those are the key levels on the Qs, and so let's take a look at the VIX, because the VIX just always gives us such good clues on these. I mean, when you see markets moving up into resistance, so again, looking at this chart of the Qs, same thing with the S&P, we had this very bullish day, and traders often get trapped in these big bullish moves. They, because we may not have predicted it, but we see it happen in real time, and we want to get in the move, and then it traps us, and we rotate lower. This is a classic bear trap right here, or bull trap, I guess you'd say, where the bears trap the bulls and push price lower off this resistance level. But the way to really navigate these is by using the VIX, because if you see naturally when the major indices are moving higher, the VIX is moving lower. So again, as we saw markets bottom for the year in early October, so right back here, what was the VIX doing? It was trading up into resistance right on this key zone that we've emphasized so strongly this entire year. If you see the VIX come up into 34 to 35 and move back down, it doesn't spend much time there and rotate lower, and the S&P and NASDAQ are at support levels or breaking through resistance, one or the other, that's your signal that it's the right time to move forward with bullish strategies. And so then we've had this sustained reduction in volatility since mid-October. So going on almost 2 months now. And we actually got down below what I consider the line in the sand, and most people do for volatility is the 20 level, right? And let me actually zoom out here so we can see the past support. So if you look at this right around this 20 level, right, and this is going back, I didn't quite go back to the beginning of the year. I could go back further, but I just want you to see at least a few of these. So kind of this 19 to 20 support zone. Every time we've encountered that this year, we've seen VIX spikes up into that 4 to 35 zone. And so as we're coming down in volatility and the S&P and NASDAQ are uptrending, what do we want to be careful for? What do we want to look for? We want to look for S&P and NASDAQ to run up into resistance. And this is where a lot of people got trapped on that big up move last week, is it was right into a resistance level as the VIX was basing at a key support level. That's actually where this is where contrarian thinking comes in. That's actually where you want to be very cautious and, possibly like be patient, see if that level gets rejected and the VIX moves up. And there you're likely to see a pullback in the market or a more extreme sell-off. And that's exactly what we've seen. And I very closely look for, in fact, we got 3 of them perfectly in this zone. What do you notice? There's trade trend buy right in that 19 to 20 zone. Trade trend buy right in that 19 to 20 zone. These both actually came in within the zone before the prediction. So the white diamond came in before we even triggered and traded up out of it. And there was another one. Those are big warning signs. When I see trade trend buy signals on the VIX below 20, I'm going to be very, very cautious with any bullish strategies and maybe more aggressive with bearish strategies. So actually, like yesterday, I shorted the E-mini NASDAQ and E-mini S&P futures and did really well today. Made about $7,000 today just on one futures contract in each of those futures markets because I saw the resistance on the daily charts we just looked at, and I saw the VIX retreat into this 19 to 20 support zone, and I saw the buy signal on trade trend yesterday. And so I put on, after the market closed yesterday, I put on just 2 one-contract short positions, one in the E-mini S&P and one in the E-mini NASDAQ futures, and closed those both out today for about a $7,000 profit, just on this one-day move. So that's why it's so important to really monitor these levels and use them for timing. So we don't want to use the VIX just by itself. We want to use it in conjunction with the NASDAQ and the S&P, and we want to look for the confluence of VIX basing at support with NASDAQ, S&P rotating off resistance. And those are excellent timing tools to help. And then also, leading up into this rotation lower on the VIX, excellent warning for not being too aggressive with long or bullish positions and being prepared for reversals off resistance, even if we haven't reached those levels yet, as a precaution for getting trapped, like a lot of people likely did on these big bullish days that we see in the markets, like we saw with on the S&P last week, right? So here you want to be careful getting trapped in these when the VIX is moving down into from such high levels down into a 20 or below level. So just always want to be careful there. So all right, so let's pause there. That's our those are our key levels for this week. Actually, let me just one quick thing to add to the VIX, because now that we are rotating off 20, I want to show you where to keep an eye on, because we talked about, right, what could happen if those support levels hold on S&P and NASDAQ. So then we'd be looking for VIX to rotate lower to make another leg lower. So we need to watch resistance, right? So 23, our first resistance zone is going to be right around 23 to 24. All right. And we almost encountered that 23, the bottom of that zone today. We also are at a mean reversion, right? So if we see VIX rotate lower here, that's a good sign that the current sell-off that we're seeing this week, late last week and this week, if we see the VIX move down and the S&P and NASDAQ hold those support levels and start to move up, that's a bullish sign, right? Then this will likely serve as dynamic resistance. Now, if we break through this resistance zone, so this is our resistance zone. All right, so if we break through this, remember the VIX can move very quickly. So it can spike, make huge percentage intraday moves and spike and then reverse lower. So I like to use the standard deviation moves on the VIX as well. So that's why I have the Bollinger Bands on here. This is a 2 standard deviation move to the upside, which currently resides around 2550. So remember, it's dynamic, so it's moving every day. But we'll want to keep an eye on that upper band for potential dynamic resistance. And then any spike above that, then we're looking kind of more at the 28. 28 is another key VIX level, 28 to 30. And then 30, really significant sell-offs and volatility expansions are going to push us up in the 35, 36 zone or higher. I don't think we've seen the VIX really sustain a breakout above that zone this entire year, even though we've been in bear market conditions and markets are down. So those are our key VIX levels. Just wanted to show you how to navigate those with in the context of the S&P and NASDAQ moves. So any questions, Richard, on those?
Yeah, question saying, as we roll into the later part of December, do you see that it's better to maybe not trade because there's not as much volume, or do you feel like the price is easier, like maybe more so manipulated during that period of time because there's not as many people in the market? Or what's your take on like the seasonality part of trading December?
Yeah. So when volumes decrease like significantly around like holidays, for instance, for what I obviously can't tell other people what to do. Everyone's, circumstances are different, but for me, I usually don't trade or lighten up my position sizing, more in cash and smaller position sizes if I do trade. And it's never a bad thing to sit on the sidelines. When you do so, you're pretty much one of two things. You're either going to miss a good opportunity or you're going to stay out of a bad one. But either way, you're avoiding the risk. So it's never bad to sit on the sidelines, is what I think. And but if I do trade on low volume days or around holidays and stuff, much smaller position sizing, and expect, potentially more whipsawing, and then also I don't put as much weight into a move around low volume. So like if you do get a significant move, whether it's in an individual stock or in the overall broader markets, I don't give it as much weight if it's on low volume because, obviously, if the volume's low, you have a lot of market participants that weren't involved in that directional move, and so it could easily, much more easily, I think, reverse on you when those market participants come back in after the holidays over. So that's kind of really the thing to look out for. And if you don't feel comfortable with it, or aren't experienced with it, it's better just to watch. Kind of see how it works, get a good feel for it, and then maybe down the road, it's something you might want to trade, but it's generally, better to sit on the sidelines if you're not as familiar with trading on, low volume periods.
Ari asked, do you generally use the aggressive position when you view the VIX?
Yeah, Ari, I do keep it on the aggressive mode on the VIX. That way we're getting all the trade trend signals. So I don't want to use conservative or moderate on the VIX. I keep it strictly on aggressive to look for these, because then it could potentially weed out one of these buys at the 20 or below level. So I keep it on aggressive. Yes.
Okay, that's all I got.
All right, cool. So tonight we're going to look at, we had some requests from members and weekly session attendees. What is this? There we go. With questions about Heikinashi. And, I often get asked if I use these types of charts, and I do in certain circumstances or for certain strategies. And, I don't use them exclusively. I still use regular candle charts as well. But we'll talk about what they are and where I think they can be useful. And most charting platforms offer this functionality. And in Zillion, you can actually use a Heikinashi chart. So if you just click on from the dashboard, you click on the candles here just to the right of the ticker box. At the very bottom, you see Heikinashi. And what I'll kind of go over what they are if you're not familiar with them. Let's go back over to, let's go to the S&P 500. So there's a couple things to be aware of. Basically, what they're useful for is identifying trend. So the formula for calculating the candle is different than a regular open, high, low, close candle. But you can see that they can be helpful for identifying trend. So when the formula for the candles is in an uptrend, you're going to see the candles generally print, if you have them set for green or red, they're going to be green. Downtrend, they're going to be red. If you're using black or white candles, generally the uptrend is going to be a hollow candle. The downtrend is going to be a solid candle. So the visualization might be a bit different depending on chart settings, but what it's really doing is kind of showing us using colors where the trend direction is, where the trend momentum is, whether to the upside or the downside. So it's really just going to be basically two color options. Now, for Heikinashi, let's talk a little bit about like how they're calculated and what to watch out for, because there are some differences between Heikinashi candles and your regular open, high, low, close candles. So the benefit is they do give us a smoother look to the chart, so they can help kind of weed out some of the choppiness, right? And the tendency is, again, you'll see during a downtrend red Heikinashi candles, and during an uptrend you'll see green Heikinashi candles. Now, what you'll notice here is, actually, this is actually not a good example. I'll show you on some other charts. But the current price, if you're looking at like a live Heikinashi chart while the market's open, the price that's showing on the chart, the current price level, is generally not going to match the actual real price of the asset. So that's something to be careful about. And that's because they use a different formula, right? So the high and the low are generally going to be the accurate high and low, but the open and the close are likely not going to show the true accurate nature of the candle. So like if you look at all these green candles, it looks like, wow, these are all this is again a daily chart. Every day, almost, with the exception of a few in here, the S&P closed higher, but not the case. If we switch back over to regular candles, you'll see that there was actually plenty of lower closes during this uptrend. So again, it's just smoothing out, making it easier to read, but that can still be beneficial. And it's kind of, it's an interesting exercise to just keep toggling back and forth, look at different charts toggle back and forth between a candle chart and a Heikin-Ashi, you can see that if you ignore the color, the chart really didn't change overall. If you look at like the highs and lows, right? All it did was really change the colors. So the opens and the closes are what's going to really be impacted by the Heikin-Ashi, all right, chart. So that's what you want to be mindful of. So it can help us, though, identify trend direction. So I don't like to use Heikin-Ashi charts by themselves as a sole means of decision-making for a strategy, because you can get tricked and whipsawed. Like here's an example. We're big sell-off here. Now, most of these Heikin-Ashi candles are red, but in between, we've got periodically some green bullish candles, right? Well, that's where other tools and methodologies become important for avoiding the false candles. So let's talk about some ways that we can do that. One of those is trade trend. So what I really like to do is use trade trend with Heikin-Ashi. And so I'm looking for basically a significant shift from green to red, or vice versa, red to green. But I'm looking for a sustained bullish in the case of a sell signal, and why I like this particular one here on June 9th. Sustained bullish uptrend from Heikin-Ashi. So we've got a significant series of green bullish Heikin-Ashi candles and a significant uptrend. All right. Now, we did get a bit of an indecision candle, but it was Heikin-Ashi red. Okay, I don't want to take this one. Here, we get a wider open close. Again, remember, that's not going to necessarily match the true price of the asset, in this case, the S&P. Okay, after the significant move. So I'm paying attention to this now. And I got a sell, pending sell from trade trend. Okay, so this signal I like, right? And turned out to be a very nice Heikin-Ashi move to the downside and a trade trend, successful trade trend short setup. Same with this one. Very sustained big move to the upside in green Heikin-Ashi candles. Sell signal. This one came in on a green Heikin-Ashi. You'll notice these two are indecision candles. So you can see they're kind of doji style candles. Okay, so I want to pay attention. I don't want to get in until I see a red Heikin-Ashi. There it is, August 19th, and a confirmed triggered entry from trade trend. So this is another nice one. This one I would have been cautious about, although it did result in a rotation higher on this buy signal, and it was a significant sell-off, followed by a transition to green candles and a doji indecision on the pending buy. It was counter trend. So the other thing I pay attention to is I also use the Bollinger Bands. So I want to look for if we're going to take a counter trend signal like this, I'm only expecting a brief maybe 2-3 candles at best counter trend trade with not a lot of potential for a sustained run. So obviously there was significant dynamic resistance here from the mean reversion, and then a continuation of the sell-off. So this one I really like. Right, here's a sell signal that aligns with the Bollinger Band trend. It's got the shift from bullish to bearish Heikin-Ashi. It's got the sell signal, and it's also in a red divergence cloud. So that's the other factor that I'll use for confirmation. So if I see upward, so here's a good one. I see upward sloping, right? We had 4 bearish Heikin-Ashis. We have a green divergence cloud. We have a transition from down to upward sloping Bollinger Bands, our mean band and our outer standard deviation bands. We have a trade trend buy signal. All 4 factors are lining up. And this one turned out very nicely. Same thing with this one, right? The sell, right? So we have downward sloping volatility bands in standard average. We have red divergence cloud. We have sell signal. We have transition. There was one up here too, but there was a number of good ones along the way. Transition from sustained green bullish Heikin-Ashi to sustained red Heikin-Ashi. Right. So those are kind of the things I'm looking for. So like today, or yesterday on the S&P, there was a sell signal. But look, and this is again why we're looking at these key levels like 3,900. So it started out, the signal's in profitable territory currently at the close today, but what is it? It's counter trend. I don't want to put on a short position with the expectation this thing is going to be one of these moves, because it's in a green divergence cloud. We're trading against the upward momentum. Our average center band and our standard deviation bands are upward sloping, and standard deviation bands are converging, which means volatility is contracting. Again, green divergence cloud. So all 4 factors do not line up on this signal. So if I take a counter trend, I treat it as a retracement or a brief mean reversion without, the expectation that it's going to be a big runner, right? So that's how I'm analyzing this to make appropriate decisions for my strategy and trade management. So kind of to sum up, they can be very useful for timing entries, especially when I find when I use them with trade trend. So again, looking for the trade trend pending signal and or trigger to be on a red Heikin-Ashi candle for a short setup, or on a green Heikin-Ashi candle for a long setup. And then using my levels, whether it's a static horizontal level or a dynamic average or standard deviation band. But I want, and then looking for that divergence, right? So my higher probability setups are going to be sell signals with those factors in a red divergence cloud, and buy signals with all those factors in a green divergence cloud. And so again, I'm looking for, with Heikin-Ashi, I'm looking for the confluence of these 4 factors to really give me the higher probability opportunities. And I think then, Heikin-Ashi could be a valuable tool for confirmation and helping us stay on the right side of the market move. Just like anything else, they're not foolproof. It's not a guarantee, and when used alone is probably not going to give you a significant long-term edge. But using 3 or 4 factors that all line up can really give you a significant long-term edge, and also help weed out if you're looking for instance, a more sustained move that aligns with your strategy. Like if you're maybe structuring an option strategy or building an options trade based on expiration and volatility and all these variables that would need some time to play out, you want to take that into consideration when looking at these metrics, because if you take a counter trend trade, in this case, the example we looked at on September 7th, where we did get a nice retracement and what would have been a nice retracement trade over the course of a few days, all the factors weren't lining up, right? So we know at least that we're taking a counter trend trade in a red divergence cloud against volatility and mean momentum, which is to the downside, and that we shouldn't expect this to be a real sustained move. Maybe it will be, but I don't want to, put my eggs in that basket, when I'm building my trade around that. So I want to build it around what the expectation is. And so that's really what can help us do is, if we see these factors align, then we can set the expectation to build our strategy and then also manage our trade. So, all right. So We can look at some more Heikin-Ashi charts, and maybe we'll do that tonight for Ticker Roundtable, but want to pause there and see if there are any questions before we transition over into Ticker Roundtable.
Let's see here. Yeah, some people are kind of looking through it. Yeah, a lot of people just find this really fascinating how this works, and then showing trade trend lined up with it.
Yeah, I think they're great. They're great complements to each other. And for me, again, like I really use them not, partly for building my strategy and managing the open trades, but also kind of helping me weed out signals if the factors don't align. And I think it could really help people with that if you're a trade trend user, a Zillion user, rather than just blindly taking a signal. You want to really look for this confluence. I think it could really help increase your win frequency, your accuracy, as well as set the expectation for your trade as you manage it.
Yeah, Eleni's just asking, are these Heikin-Ashi indicators available on Zillion?
Yes, they are. So all you have to do to get to a Heikin-Ashi chart on Zillion is either from the main dashboard, or if you expand the chart like I have it now, you just select the little candle dialog box here to the right of the ticker box, and it's a drop down, and you'll see at the very bottom you have a Heikin-Ashi, and you can just toggle those over. And you'll know it'll say to the right of your selected ticker, whatever chart you're looking at, it'll say Heikin-Ashi there. So don't forget that you're on it as well, because you'll want to, you'll want to know that you're looking at a Heikin-Ashi chart, because again, the big thing is the current price on a Heikin-Ashi is almost never going to match the actual price of the asset in real time, right? Because those are different calculations. Now the wicks, the highs and lows are going to be your actual high and low on the candle, but the opens and closes are not going to be the same.
Gotcha. Yeah, that's kind of Roger's question was, do the wicks on the candles say anything?
Yeah, they should match up to the high and low. So like this is a Heikin-Ashi chart. Like if we, let's just take this high after this run up, and then the rotation lower on August 16th, right? So the high on that day was on the S&P was 43.2528. So 43.2528. And then if we go over to a standard candle, we see that our high was 43.2528. So the highs and lows should match up, but the open and close will be different.
Steve wants to know if you can take a look at VLO.
V is in Victor?
Yeah.
Okay. I think that's Valero. Yeah. Valero Energy. Okay, so current open sell on Valero. This was a good one in a green divergence cloud, so that would be counter trend. You'll see that there's a strong oops, didn't have my tool out there. Thought I did. Oh, why is that not working out? There we go. Resistance zone. All right. So we have this big run up into this resistance zone. We had some pretty choppy Heikin-Ashi here, but in green divergence cloud, but we did get a pending sell on the transition from green to red. So that part of that factor lines up for me, because again, we're really looking for sustained directional move. So you're going to see a lot more green Heikin-Ashi with some peppered in red here, right? But there was the sell, and again, I would consider counter trend, except for the fact that it occurred after this very strong run up into a resistance zone. So this one might not be as perfect as some of the ones we looked at on the S&P, where all 4 factors were in alignment. But this pretty much has all of them without the divergence cloud lining up. There was obviously upward sloping momentum on our mean and volatility bands. So as this triggered, which was down around this level, we see those. This is really where for me, the move was confirmed, as we see the average rollover and this is actually what we also term a slingshot setup, and the volatility bands diverge. So we get volatility expansion with the sell-off. So this is just really confirming what really started out as a a valid but lower probability counter trend setup, when now turning into what I would consider, obviously in hindsight, was looking like a really nice setup. But let's see. Let's actually see where this. Let's toggle over to 119.93. Let's toggle over to a candlestick chart, right? So you'll see how the close from today, the price is different than what we just saw on the Heikin-Ashi chart. So it actually closed today at, the real price was 118.81, or sorry, 86 on the close. So if you look at, again, the Heikin-Ashi, it's showing the close is a bit higher. So this is not the accurate price, but you can see that it helped us identify the downtrend and the transition. And so we can still map our levels here on this Heikin-Ashi chart. And you'll see that they can often make it easier to spot trends around key levels, right? We can see if there was a downtrend through a level or an uptrend through a level, etc., or a downtrend into a level. So looking at this, kind of right around the 119, 118 support zone, we see prior support and resistance. Okay. So this is proven to be a nice signal and worked out in alignment with the Heikin-Ashi chart. But let's toggle again over to candlesticks. Really want to be watching, maybe it's a bit lower than I said, like we're kind of in a support zone, like 118 to, just looking back here at some of this prior resistance, like 118 to 115. So that might be a potential reversal point back up on this sell-off on Valero.
Let's see. Don't like that, really.
It's saying it was the best Bollinger Band and standard deviation I've ever seen.
Yeah, he was saying like this is Elliot. He's talking about he saw you at the Metastock event.
Oh yeah.
And then watched the presentation. Then he was saying like somehow presentation changed or something after the fact. Like he copied the real one and then maybe they edited it or something. He was saying it was a really great presentation talking about that.
Oh, good. Thanks, Elliot.
Steve, just while you're still on Valero, he's asking if we're still in a green cloud.
Let me look at the scanner and see for confirmation. Let's go. If you're ever uncertain, the best way is just go to your scanner and then, make sure you're looking at all assets, type the ticker in, and it will show you, because it's definitely faint and it looks like we're out of it. And this is a way to really confirm that, because versus using the visual on the chart when the cloud does get faint. So now we're actually out of the green divergence. So there's currently no cloud on Valero energy. And then you can also see, obviously, the sell came in the sell signal came in 5 days ago. So yeah, no current divergence cloud on Bolero at the moment. That's a good way to verify that. That looks a little hazy on the chart.
Let's see. You taking any more tickers? I got a couple.
Yeah, let's take a couple more. We're right up in the hour, but we'll take a couple more for you guys. If you guys want to look at some, let us know.
Yeah, I got GLD.
All right. Gold ETF. Yeah, so gold, it's stuck in this range and kind of really is still in the range at the top of it. Since it sold off earlier in the year, but we haven't had a nice run up from the bottom of the range from early November. But let's take a look on Heikinashi and see what things are looking like. So this is a good buy signal from November 4th because we had we're in a green cloud, right? Transition from red to green. We had prior sustained down move in Heikinashi. We had the red to green transition, the buy signal, the trigger, and then the upsloping volatility bands. So this is a really nice one. We had a counter trend sell, wouldn't take that one. We've got a buy that did not trigger. So currently, no, it doesn't look like any current signals on GLD, but strong resistance here, right? So right around 167, if we want to make more of a zone out of it, 166 to 168 is very strong resistance on GLD. So that's now being that we're trading below. Let me go back over to a candlestick chart. So being that we're trading below this resistance zone and we rotated lower from that level, we're going to be watching, want to watch for, and really I'd like to use more of a zone, 166 to 168. If we get, if we can break through 168, then that's bullish and expect a continuation of the up move. But since we're really just right now mean reverting off this resistance zone, I'm looking for, and we're getting a volatility contraction, so the outer bands are converging. I'm looking for dynamic support around the center band. So I'm watching the center band to see, do we get price action into that band and then a rotation higher for a continuation of the uptrend, or opposite of that, do we get a close below and move to the outer two standard deviation band. But overall, mostly bullish because we're in green divergence. The thing is, we've encountered a significant resistance zone between 166 and 168. So that's going to be, considering past rotations off of this level and prior support before breaking through and transitioning it into a resistance level in mid-June, is a very strong zone that we'll need to break through for bullish sentiment on GLD. And otherwise, overall structure is ranging. So bottom of the range is kind of right around 150 to 152 is our lower zone range, with some embedded areas of support to keep an eye out for. All right, let's do one more.
Deborah asked for CTSH.
Okay. So Cognizant Technology Solutions, not real familiar with this name. And we'll start out looking at a Heikinashi. So we did have a, I'd want to look at the scanner just for confirmation here. Looks like we are probably outside of a cloud, but we did have bearish divergence in this down move in August, September, October. And then we rebounded early November. So there's our run up in green Heikinashi. We had a buy signal there. And that was stopped out on a trailing stop in profitable territory yesterday or today, actually. So there is no current trade trend signal on this stock CTSH, but we did get a transition from green to red. Again, it looks like this is in the absence of any divergence, and we have the center band sloping up and the outer bands converging, meaning that we're getting some volatility contraction, and we might anticipate less significant intraday moves in the near term. But we found support here. So, this would be, this bearish Heikin-Ashi would be counter trend. And my expectation would be, unless we close below the center band and continue to see selling pressure, more of a counter trend move. And so here, this is a scenario where I look for, to be with the trend, for transition then from red back to green Heikin-Ashi, so that I'm trading in the direction of the momentum again, which is signified to me by the upward sloping center band. And when we see volatility contraction, again, that tells us that we should expect maybe less significant intraday moves, or more steady uptrend. It's when we see significant sell-offs like this, where we see expansion, and that's where you see the outer standard deviation bands diverge. So that's how we use that indicator, and really is the way to use it in close to real time versus, giving us lagging information, because we're using it with price at the time. Now, and it reacts very quickly. So this one's a bit tricky. So again, no current signal, no current cloud. All we really have is a transition after a run up from Heikin-Ashi from green bullish to bearish, but probably more, unless we get a break of the median, more of the mean, more of a retracement without further confirmation, volatility, contraction. And obviously that's a short-term analysis of this stock. I'm not familiar with the name, but it's, apparently gotten really hammered this year with the rest of the market. So, not a comment on fundamentals or quality of the company or anything of that nature. As far as resistance 65, just eyeballing it, looks pretty significant here again. And what I really look for with these horizontal static levels are key rotations, multiple occurrences off that level, whether it's up or down. So up would be using that level as support, down would be using it as resistance. And then I look at where price is currently trading relative to that level. If we're below it, then we're bearish as it relates to that level, which lends a little bit more weight to the bearish Heikin-Ashi, being that it is off this key 63 resistance level, where we see a lot of price action. And so then, if I were going to take a counter trend position, I'm always looking for lower support, right? Where might I see price stall or reverse, so that I'm prepared to exit the position before it reverses on me. So we see, some significant support around 57 and around the 52 to 54 zone. And looking at Heikin-Ashi, you want to confirm your exact prices. Anytime you use Heikin-Ashi, you'll want to confirm actual current prices in the asset with a standard candle. So right now the stock on the close today is 59.64. So yeah, those are some great ones to look at. I think good examples of Heikin-Ashi and how to use that. And so hopefully you guys got a lot out of that tonight. We'll use it more moving forward. And we'll even look at using it in the future with building trades around it. For now, I just wanted to look at the mechanics of it, the rationale for using it, some of the other variables that we want to, incorporate for our decision making. And then so down the road, we'll look at using Heikin-Ashi and trade trend and some of our other tools like divergence cloud and Bollinger Bands to actually build some example trades around with options and other things. So, all right, guys. Well, we ran a little over tonight, but I hope you guys come back again next week. We'll be back next Tuesday, same time, same place. Are there any final questions, Richard, before we wrap it up for tonight?
No, Lala was just saying that CTSH is a tech support company providing services outsourcing mainly to India, like INFY.
Oh, okay.
There you go.
Good to know. I will do a little research on that one. Well, those
That's all I
are
got.
some
Everyone
great ones to
says
look at.
thanks a lot. Great session.
Thanks, guys. Appreciate that. Well, I hope you guys have a great rest of the week. Again, really watch that 3,900 level tomorrow on the S&P. That's going to give us a lot of indication in terms of bullish or bearish sentiment moving into really, I think, the rest of the year. So let's keep a close eye on that. It might remain in play beyond just tomorrow, but let's really pay close attention to how the S&P reacts around that 3,900 level. And then we'll follow up with that when we see you guys next Tuesday. So have a great rest of the week and looking forward to seeing you guys next week.